Hi. So this is a little different from my usual insights videos, which are about principles of investing. This is also about where markets are today and what you should be doing. But there is a principle involved here too, which is that do not spend your time just looking at whatever the ticker tape or the business channels every day where there are explanations being given for what happened yesterday or what's happening today, because the day to day moves in a market are random. So one day the Indian market follows the US market, we say it's global trends. The next day it doesn't, then India is decoupling. So all of which is complete nonsense. Most of the daily moves are simply random movements unless there is some news actually which has come in. But what helps is stepping back and looking at long-term data. So coming back to the Indian markets as we stand today, beginning of October 2023, where are we? I mean, first you look at markets, let's say for 40 plus years, which is when the indices have been around. So if you invested in 1980, in that decade, if you'd invested 100 rupees at the beginning, after 10 years, you would have got 700 rupees back. If you had invested in 2010, that same 100 rupees, you would, at the end of 10 years, you would have got only 230 rupees back. So, I mean, all of us think that equity markets are volatile, and we think that, there'll be some differences from one year to the other, but differences can be as stark as this, and not just over 1 or 2 years, but over a full decade. But this also tells you that, we expect equity markets to compound at 15-16%, instead of which in that 2010 to 20 decade, they compounded at less than 9%, far below the trend line. Thereafter, while India started to outperform because of all the COVID and many other international changes, also the markets have only compounded 12.5%. So the point is this: if you look at a long-term chart, we are far below the trend line of what we think the normal returns from equity markets in India should be, which is 15-16%. Even if you take it a little lower, the fact is last 10-12 years you have done far worse than that. So the risk of a crash comes when you are far above the trend line. If you are not facing an imminent crash, then it makes sense to remain invested. So in March I had made that call very categorically. It's there on my Twitter feed that it's time to get back into the market, otherwise you will miss out on an up move. I mean, there were no ifs and buts and this and that. The most likely move is up, and so you miss that, let's say. But even now I would say whatever is your equity allocation, it is time to be invested. Now this is about the Sensex Nifty kind of stocks, the large caps. But small caps are a different story, and small caps, again, if you look at the long-term history, and many investors among you may be relatively new, you would not have lived through those ups and downs. So let me tell you how severe those ups and downs can be. So in 2008, the small cap index made a high, and then it crashed over the next about 14-15 months. It crashed almost 80%. And then to reach that 2008 level, it was 2016. So it 8 years plus it took, from the bottom 7 years plus. So, and also remember that in the small cap index there is so much churn that in 5 or 6 years it's a completely different index. So I mean, that index that made that high in 2016 was not even that index that went down in 2008. And you will find people picking up a point and saying, see, small cap index can go up 5 times by picking the low and then the high. The point is, if something falls 80%, even if it goes up 5 times, it is only come to base zero. After 8 years, you've made no returns, even after it has gone up 5 times. And this was not the only instance. After that, you had this bull market in around 2017, and then 2018 there was another crash, almost 2/3 crash, 65% down. And again, it had to triple to come back to base zero. So that's the history of small caps. It's a risky end of the market. There is too much money flowing in there. If you look at the mutual fund, there are actually net outflows from the large cap space to the small cap space. from whatever data is out there, it appears that the small cap mutual funds have had to dilute their criteria because there's so much money coming in that they have to find more and more stocks to invest in. So all those are danger signs. So I mean, bottom line, I still like the large cap space, but you have to be very cautious investing in small caps. In any case, when you're investing in small caps, don't let it be beyond, let's say, 20 or at the maximum 25% of your equity portfolio maximum. So keep that in mind, and if you have questions and comments, most welcome.